A few years after Citigroup shut down its personal banking operations in China, it made another significant announcement. On September 5th, Citigroup stated in a press release that due to a gradual reduction in its personal consumer business with Unionpay in China, Citigroup China is no longer a member of Unionpay. However, the statement emphasized that the bank's services for domestic and international payments for businesses and institutions remain unaffected. Citigroup also confirmed that it would continue to serve companies and institutions in China to meet their cross-border banking needs. At the same time, Unionpay also confirmed this in a statement. Unionpay, a payment giant established by institutions like the Industrial and Commercial Bank of China, operates a global payment network covering 183 countries and has over 2,600 member organizations. Yet at this moment, it has lost Citigroup as a partner. Earlier reports suggest that this exit was not out of nowhere. In fact, Citigroup had been gradually scaling back its retail business for years. And this move in China is just part of its ongoing shift towards focusing on corporate and cross-border services. Specifically, Citigroup China initiated a global strategic adjustment in 2021, planning to exit the personal banking business in multiple markets, including China. In December 2022, they officially announced the closure of their personal banking operations in China, stressing that it would not affect their services for businesses and institutions. Shortly thereafter, in 2023, Citigroup sold its retail wealth management business in China to HSBC Holdings and reached an agreement with Fubon Huayi Bank to transfer its personal credit card business and unsecured loan assets, with the deal set to close in 2024. At the same time, Tianya data revealed that Citigroup China underwent a corporate change in August, with Lu Weiming stepping down as chairman and being replaced by Xing Baolian. This could signal further internal adjustments, pointing to a deeper transformation. This event is not isolated, as other foreign banks have already begun taking similar steps, gradually scaling back their cooperation with China. For instance, in February 2025, Wall Street banks overall began to reduce investments in China, with layoffs and strategy adjustments becoming routine. Major players like JP Morgan Chase and Morgan Stanley are re-evaluating their growth plans. Earlier examples include 2024, when Standard Chartered and HSBC also adjusted their retail businesses in China, focusing more on corporate services. Although HSBC acquired Citigroup's wealth management portfolio, it also faces pressure with its workforce in China. Another interesting case is Wells Fargo. In July 2025, due to an employee being banned from leaving the country, Wells Fargo suspended all employee trips to China. There has been speculation that foreign executives involved in investigations in China could face detention, making it difficult for firms to invest confidently. Citigroup's century in China stands out at a time when many foreign investors are pulling back. Citigroup's story in China dates back over a century. It opened a branch in Shanghai in 1902, becoming one of the first American banks to enter China. At that time, foreign banks mainly served international trade and business, and Citigroup quickly established a presence in Shanghai, Tianjin, Hong Kong, and other cities, leveraging its global network. After China's reform and opening up, Citigroup returned to the Chinese market in 1983, gradually expanding its operations. In 1998, it became the first American bank approved to operate in RMB business in China. In 2007, Citigroup China Limited was established, becoming one of the first foreign-owned banks registered in China, marking a high point for its retail operations in China. Since then, Citigroup frequently made moves in China's retail sector. It launched credit cards, set up wealth management and private banking services, and expanded its presence in major cities like Beijing, Shanghai, Guangzhou, and Shenzhen, attempting to replicate its global retail experience. At the time, many believed that Citigroup had the best chance among foreign banks to establish a foothold in China's retail market. However, looking at Citigroup's exit today, the reality has proven far harsher than anticipated. Analysts believe that Citigroup's departure from Unionpay is not simply a business decision, but the result of multiple factors coming together. Firstly, the gradual contraction of Unionpay's personal consumer business points to China's economic difficulty as a primary cause. From 2024 to 2025, China's overall economic atmosphere is characterized by a weak recovery, strong pressure. The official GDP growth target is around 5%, but actual performance has consistently fallen short. While consumption sees short-term rebounds during holidays, everyday spending remains cautious. What's more troublesome is that the real estate sector, a super engine, is still undergoing painful deleveraging. The lingering effects of corporate debt defaults, falling second-hand home prices, and a sluggish new home market with homes unsold, related consumption sectors like home appliances, renovation, and furniture are naturally affected. Additionally, in 2025, China's ability to attract foreign investment continued to weaken. According to data from the Ministry of Commerce, actual foreign investments from January to April amounted to 320.78 billion yuan, a 11% year-on-year decline. By May, the cumulative decline further expanded to 13%, totaling 358 billion yuan, around $50 billion US. On the surface, the number of newly established foreign invested enterprises continued to grow, with a 12% year-on-year increase in the first 4 months, marking a new high in recent years. However, this growth reflects more of a registration boom rather than actual capital investment. The actual capital inflows are undergoing a structural change. High-tech and service industries still attract some interest, but traditional sectors such as real estate and retail manufacturing have seen a marked decrease in foreign interest. For foreign banks, the current environment has made the retail landscape increasingly less favorable. Retail banking typically depend on consumer loans, installment plans, credit card usage, and wealth management products to generate profits. However, with low demand for loans, limited growth in credit card spending, and a cooling market for wealth management products, many consumers are opting to save their money in big banks for stable returns rather than risk investments in fluctuating wealth management products. Citigroup's retail operations in China were already on the periphery. Without the large network of state-owned banks or the customer base of local joint stock banks, its market share was much smaller. In a climate of weak consumer confidence and limited investment returns, foreign banks like Citigroup found it difficult to expand their market through credit cards, installments, and wealth management. Meanwhile, local giants were able to maintain growth, benefiting from economies of scale and favorable policies, while foreign banks face higher customer acquisition costs and more complex compliance requirements. In this context, staying in this sector offered Citigroup no scale advantages and limited capital returns, making an exit almost inevitable. Looking at the broader picture, China's economic outlook for 2025 shows a slowdown from 2024's 5% growth to 4.5%, with trade restrictions and weak export contributing significantly. Foreign withdrawal isn't limited to banks. Sectors like automotive and manufacturing are also showing signs of decline. For example, changes in multinational company strategies have led to a drop in FDI in the automotive industry. These cases mirror China's struggle to attract foreign investment, high saving rates, overcapacity, and accumulated debt. Citigroup's sale of its retail wealth management business to HSBC is a microcosm of this exit wave. While HSBC took over, it too faces similar challenges. Digging deeper, the motivations behind this move go beyond business logic. They also involve geopolitical considerations. Citigroup's exit could be seen as another step in the decoupling of China and the US financial sectors. In 2025, as the US raises tariffs on China, China is becoming a high-risk zone for foreign investment. Starting in 2025, tariffs on China will continue to rise according to the established schedule, particularly on key sectors like semiconductors and upstream photovoltaics. At the same time, the US has set permanent reviews or even investment bans on foreign investments in sensitive technologies in China, requiring more regulatory hurdles for investments and mergers. For global banks and multinational corporations, this means higher cost, longer timelines, and fewer opportunities. Meanwhile, the broader trade environment is also raising external barriers. The EU has imposed final anti-subsidy tariffs on Chinese electric vehicles, while Canada announced in 2024 that it would impose a 100% tariff on Chinese EVs. And starting in October 25% tariffs on Chinese steel and aluminium. For multinational manufacturers looking to base operations in China and export to Europe and the US, rising external costs and increasing uncertainties are presenting new challenges. As a result, the traditional model of China-based production for overseas markets now requires a complete re-evaluation. Of course, this is also tied to policies released by the Chinese government. On one hand, the government has issued policies to encourage foreign investment, allowing foreign companies to establish new ventures or increase their capital. On the other hand, through national security reviews and data security laws, it has created invisible barriers. The 2023 revision to the anti-espionage law have greatly blurred the definition of national security, meaning nearly any economic activity could be subject to review. Meanwhile, the data security law and personal information protection law implemented in 2021 impose complex approval and filing processes for cross-border data transfers. Since 2023, multiple consulting and due diligence agencies have been investigated, searched, or fined. For example, in 2023, the US-based Minsk Group, which specializes in corporate investigations, was raided at its Beijing office and 5 local employees were detained. In August of the same year, the Beijing Statistic Bureau was fined approximately 10.7 million RMB for conducting unauthorized foreign statistical surveys pointing directly to sensitive areas like foreign statistics approval. Consulting and expert networks such as CapVision have also faced scrutiny, with branches in cities like Beijing, Shanghai, Suzhou, and Shenzhen being investigated for potentially providing sensitive industry intelligence services. Bain & Company's Shanghai office was also raided by police, with employees questioned and equipment seized, though the reasons for this action have not been made public. While the Chinese government emphasizes high-quality development, its increasingly strict regulatory environment is making foreign investment feel suffocated. The broader implications of Citigroup's exit from Unionpay have sparked analysis that it is a setback for the internationalization of China's financial sector. For the past 20 years, Unionpay has been expanding in 2 key directions: unifying domestic bank card networks while quickly growing its international presence and partnering with global institutions. The goal has been clear: to create a Chinese version of Visa MasterCard. Foreign banks were originally seen as key partners, offering both credibility and a bridge to international markets, helping Unionpay project an image of openness and global interconnectivity. However, Citigroup's exit has disrupted this narrative. With foreign members already few in numbers, losing one more means Unionpay's global reach now depends more on Chinese banks to tell its story, without the natural credibility that multinational institutions bring. While Unionpay can still claim to cover over 180 countries and regions, international investors know the true test of global quality lies in the ability to attract and retain top foreign partners. This signals an awkward moment for China's financial strategy. On one hand, regulators continues to emphasize expanding financial openness, encouraging foreign investment and the establishment of new companies. On the other hand, foreign banks are pulling back from retail, even dropping symbolic positions like Unionpay membership. The result is clear. Unionpay remains strong domestically but struggles to expand internationally. Looking at the bigger picture, the collective retreat of foreign banks could worsen the decline in China's FDI, impacting economic growth. The World Bank predicts China's growth will fall to 4% by 2026. Interestingly, while China is stimulating the stock market and easing monetary policy, foreign capital is leaving. It's almost like trying to pull with one hand while pushing with the other. From Citigroup's perspective, this is a natural part of its global strategic transformation. In 2021, Citigroup announced it would exit consumer businesses in 14 markets, focusing instead on more profitable sectors like institutional and wealth management. In China's retail market, Citigroup faced pressures from state-owned giants like ICBC and CCB, as well as the higher cost of compliance and operations, data localization, anti-money laundering, and consumer protection increased fixed costs. Customer acquisition expenses remained high, and with mobile payments dominating, the effectiveness of credit cards and installment plans weakened. Expanding credit cards, installment services, and physical branches require long-term investment with extended return periods. In contrast, Citigroup has retained a strong presence in other countries like Singapore, Hong Kong, and UAE, and London, where there are substantial offshore capital pools, more favorable institutional and tax environments, and more flexible capital arrangements. These hubs offer client structures that align closely with Citigroup's global private banking model, naturally connecting to the group's product and trading pipelines. The same investment yields higher returns and better scalability in these hubs compared to China's retail market. Therefore, instead of staying stuck in the retail sector, Citigroup decided to redirect its resources towards its strength in cash management, trade finance, foreign exchange, and custodial services for multinational corporations. This shift allows a bank to better leverage its global network, while state-owned banks like ICBC and CCB, along with payment giants like Alipay and WeChat Pay, continues to stabilize the market. Their profitability is slipping. They may be getting bigger, but that doesn't necessarily mean they're making more money. Economists point out that Unionpay is still trying to expand internationally, but because of low foreign involvement, it's increasingly seen as China's own network, with limited global appeal. The internationalization of RMB also faces significant challenges as the domestic economy remains weak and foreign interest in RMB assets remain low. Looking ahead, China's path to financial internationalization will likely depend on offshore markets like Hong Kong. By gradually expanding trade settlements and bond markets, China can increase the use of the RMB, but replacing the US dollar is still a distant goal. Citigroup's decision to exit Unionpay may seem like a specific business move, but it highlights a bigger issue. China's sluggish economy and increasing regulatory challenges are making it tougher for foreign banks to do business there. Analysts predict that foreign banks will continue to scale back their retail operations in China, focusing instead on more stable, lower-risk areas like corporate banking and cross-border settlements. Citigroup's exit from retail could be the first of many, with more multinational companies facing the difficult choice of whether to stay or leave.